morning. You're watching Business World Live. I'm Danie Laurel. It's 10:06 a.m. It's this Friday morning here in Metro Manila. We are about 36 minutes into this trading day. It's the last trading day of the week, guys, and happy Friday. But let's kick off with our main story. The country's gross revenue index slumped to a record low in the second quarter. That's as most businesses were disrupted by the COVID-19 restrictions. Data from the PSA's quarterly economic indices showed that the composite measuring sales earned by companies shrinked by nearly 27%. That's the biggest contraction since the year 2000. The second quarter reading was a reversal from last year's growth of 6.2%. You can see on your screens here of the 8 indices, only insurance and financial activities recorded growth that's coming in at 12.5%. The three biggest declines were in the areas of transportation, storage, and communication, real estate, and manufacturing. Union Bank chief economist Carlos Unchon said the steep decline in gross revenues reflected the 16.5% GDP contraction in the second quarter. IHS Markit Asia Pacific chief economist believes the index will recover in the coming months. That's as businesses reopen. Now, for the overall economy, Oxford Economics is painting brighter prospects for recovery as of September. The country's recovery scorecard eased to negative 12. That's from negative 4 in June, putting the Philippines at a higher rank among its Asia Pacific economic peers. Now, despite the improvement, the Philippines still scored negatively in the four components, which are vulnerability, stringency, containment, and policy. The Philippines now ranks fifth from the bottom, that's up 3 places from June. Kicking off the markets report with some news from offshore, that is, of course, in the United States. You can see on my terminal here the U.S. Treasury yield curve. That is as the Fed held its rates near zero. That was on Wednesday, and apart from that, also vowing to keep their interest rates at this level, so nearing zero until inflation is back on track, overshooting the target of the central bank over in the U.S., which is at 2%. So until it has shot over 2%, they will be keeping their rates rather low. This is a bold new promise, which of course is aiming at improving the economic conditions over in the US, bringing millions of people in America, which are out of work, back into the labor market. But this had also marked the start of a policy debate in terms of monetary policy, because before it was focused on a crisis era. This is according to analysts looking at the Fed very closely. Before, it was basically in crisis mode, keeping the markets afloat during the pandemic. Now it's about managing a steadier multi-year recovery. This, I cite Jerome Powell of the Fed, of course, saying effectively what we are saying is that rates will remain highly accommodative until the economy is far along in its recovery. Now, in fact, over in the US, some positive news in that the new economic projections are showing that policymakers are now seeing the US economy shrinking by 3.7% this year. Now, the good news here is that that is far less than the initial decline or contraction they were seeing in the economy at 6.5%, which was forecasted in June. Further, they were looking at unemployment, which had registered 8.4% in August, dropping to 7.6% at the end of the year. So some good news there in the economic front over in the US. They say the recovery is here and it is well along, even if it will be taking some time. Now, Donald Trump has said he was also more open to more stimulus spending for the pandemic relief there. And he also said that a coronavirus vaccine could be distributed widely to the public as early as October. But this contradicts some statements by some of his top health officials. Now, however, you do have the Bank of Japan taking a less pessimistic view of the economy. That was also happening yesterday. They left their monetary stimulus untouched. This, of course, as global COVID-19 cases are now approaching the 30 million mark. Let's take a quick peek at our own local currency and how that had reacted amid all of these Fed issues. You can see us actually strengthening this morning. We're now at 48.411 to the greenback, but this comes after we weakened as the dollar strengthened after the Fed had held its rates. Now, this according to RCBC's chief economist Mike Ricafort, the peso was weaker yesterday versus the dollar because of market risk aversion. That's after the statements of Jerome Powell, because he said that there, even as they held the rates, there was not any additional stimulus measures that were announced, and most emerging currencies actually fell as the dollar rallied and more people and investors went into the safe haven currencies. Let's take a quick step back and take a look at how equity markets had performed on Thursday. They are correcting a touch. The Dow Jones down by 0.5%, the S&P 500 down by 0.8%, and the Nasdaq slumping by 1.3%. And this amid expectations that Asia was actually supposed to be improving this morning. And you can actually see a rather mixed picture here with the Topix up an inch by 0.12%, but the Nikkei 225 still in red territory. Over in Hong Kong, you've got the Hang Seng up by 0.4%, but Shanghai and Shenzhen also enjoying some gains. So over the board, very different pictures here. You do see over in Singapore, the FTSE Straits Times suffering a bit of a sell-off this morning. So again, not very clear, mostly tilted towards the green territory. This, of course, also as crude oil held near $41 a barrel. So crude oil strengthening there. Let's take a look at our own markets. We are not following the positivity that we are seeing earlier on in the rest of the Asian stocks. Take a look at our index now at 5907.83. That's dangerously close to breaking below 59 levels yet again. We are down by 0.6% in just the past 3 days of trade. You can see us down by 1.8%. So it's been a very topsy-turvy week. This after we had closed flat yesterday. And this, according to Luis Lumlingan of Regina Capital, it was very muted in terms of trading. Value turnover was still, however, better than the day prior. We did have 6 billion pesos worth of shares being exchanged. However, the bad news is we did see net foreign selling yet again. That's the 11th straight day. Rather the fifth straight day, but it is the worst we've seen in 11 days in terms of an outflow. So we lost 1.2 billion pesos from our foreign investors yesterday. That's the highest since September 2nd. Now let's take a quick peek at whether there are some bright sectors here. None whatsoever, with everyone feeling the pinch. Property players in particular, most sold off here. That's down by more than 1%, being followed by services down by 0.7%, and all across the board, industrials the less or least hit compared to the others. So let's take a quick peek at our big gainers. Whether there's, I did mention properties actually slumping the most, so whether that is actually being dragged down by a specific company, I'll just pull that out for you guys. As we actually open these markets, is of course we're around 40 minutes into the trading day, so there's still some hope there for a reversal here. Let's take a quick peek. You've got pure gold actually bearing the brunt, so that's down by 1.8%. But as I mentioned, property players SM Prime and Ayala Land are the ones dragging the index down quite obviously. So Ayala Land down by 1.4%. Still a lot of bright spots. However, you've got Jollibee Foods that's up by 1.5%. First Gen as well. So power companies in the leaderboard. Metropac, of course, also owns power company Meralco. So some sort of theme going on there. But otherwise, it's a very mixed bag for all the rest of the index players. Now let's take a quick peek at AC, because I did want to take a look at that on the back of news that they're going to be beefing up their healthcare offerings. Now, AC Health is going to be building 100 clinics. That's as the COVID-19 pandemic spurs the hospital fear. Now, this expansion, according to their president, Paulo Borromeo, would make it the largest clinic network in the country. So they're going to be widening their portfolio to family, multi-specialty, and corporate clinics. Right now, they only have 7 mall-based specialty clinics and 40 corporate clinics. Recall that they had acquired Healthway Medical last year. So they have now served around 3 million patients. And so this will be happening within the year. Very exciting times for Ayala Corporation, particularly Ayala Health, despite the fact that they are not really feeling the love this morning. As I mentioned, their real estate unit is one of the worst performers. They're down by 1% to 708 pesos. Another big one I'd mentioned SM Prime. Let's take a quick peek at their parent company. That's, of course, SM Investments Corporation. This as they tap the bond market, just like other conglomerates we have seen. They have now priced their 3.5-year bonds. That's couponed at 3.3613%. So they've gotten the go signal from the SEC for 30 billion pesos worth of debt. Now, they will be using this debt to refinance existing loans. SMIC down together with the rest of the local boards. Again, SM Prime possibly pulling that down. That's down by 0.7% to 898 pesos and 50 centavos. So more on markets later on in the broadcast. We got Japhet Tantiangco of Philstocks. Okay, let's check in on the biggest headlines on this, the last trading day of the week. Now, it seems like the country's top tycoons are also feeling the pinch from the COVID-19 pandemic. That's as Forbes reported that their collective wealth declined by 22% to $60.6 billion. The 2020 Forbes Philippines' rich list reported that 32 out of the 50 tycoons saw a drop in their net worth this year. That's as the economy plunged into a recession. The SM Group's C siblings topped the Forbes' list. That's with a net worth of $13.9 billion. Their fortune was cut by $3.3 billion. Vista Land's Manny Villar ranked second meanwhile with a net worth of $5 billion. That's a drop from last year's $6.6 billion. Villar was followed by ICTSI chairman Enrique Razon, who saw a 16% drop in his net worth to $4.3 billion. Rounding up the top 10 list are JG Summit's Lance Gokongwei and his siblings, the Ayala Group's Jaime Zobel de Ayala, Alliance Global's Andrew Tan, LT Group's Lucio Tan, and San Miguel Corporation's Ramon Ang. JFC's Tony Tan Cationg ranked 9th, but his net worth was cut by 37%. That's as his business was badly hurt by the lockdown. Whereas Pure Gold's Lucio and Susan Ko claimed the top 10th place with a $1.7 billion fortune. Now, NEDA is looking to reduce the country's reliance on foreign aid. That's as it prepares for a reclassification to upper middle income status, at which point it will lose access to concessional rates. The Philippines' official development assistance or ODA portfolio reached $20 billion as of March, a big chunk of which is in the form of loans. Japan was the top source of foreign aid, providing at least 40% of the total. The government is targeting to achieve an A-level credit rating by 2022 to offset low access to low-cost loans. That's as the country moves to a higher income status. The country had been reliant on international aid to fund many of its projects, particularly its infrastructure push. About half of the government's 104 infrastructure projects will be funded through ODAs. You can see on your screens here, only 2 projects have been completed so far. 44 are under construction and the rest are either in preparation stage or waiting for approval. The 2 finished projects are the Angat Water Transmission Improvement Project and the Luzon Bypass Infrastructure Project. Economic Planning Secretary Carl Kendrick Chua told senators in yesterday's committee hearing that all infrastructure projects are either being implemented or will be started next year. With the economy in a recession due to the COVID-19 crisis, Chua said projects that have the maximum impact on recovery would be prioritized. Manila City fell 10 spots to near bottom of the IMD's Global Smart City Index. Manila ranked 104th out of 109 countries, receiving the lowest mark of a D this year. That's from last year's C. The report noted that Manila residents raised concerns about pollution, road congestion, and public transport. IMD said residents also highlighted the supposed corruption of government officials, causing the drop in Manila's ranking. The IMD survey, which was conducted from May to April of this year, covered 120 residents in each city and measured citizens' perception in terms of the impact of technology on their quality of life. The index also showed Manila had the worst ranking among 8 cities in Southeast Asia and 34 cities in East Asia and the Pacific. Guys, yet another trading week has passed us by without the index breaking above the 6,000 resistance level. But despite the thin trades, we are still watching several stocks as we look forward towards the last quarter of this volatile year. Here to share with us some insights on the latest news, we have Philstocks Japhet Tantiangco. Hi, Japhet, and welcome back.
Good morning, Danie. My pleasure to be here.
Japheth, let's kick off, with the offshore sentiment here, especially after the Fed's comments. It was widely expected that they would hold their rates, but it was a very mixed reception in terms of was his statements, positive for the economy? Was this, very very cautious tone? Expected by investors. What is the general global sentiment that Fed Chair Powell's speech has given?
Well, as we all know, the Federal Reserve chose to hold rates at 0 to 0.25%. So that's the benchmark rate of the Federal Reserve right now. And it conveys two things. At first, this was only for the emergency to battle the pandemic. But suddenly there's a change of narrative saying that this is going to go on until at least 2023. So this is moving towards the long term. And this implies that somehow there's weakness in the US economy. For you to hold down your monetary policy rates at low levels for a long period of time conveys that there's an ongoing problem or ongoing weakness with the US economy itself that warrants the need for such ultra loose monetary policies.
Okay, so it was expected that they would hold, but it's actually quite worrying given that they will hold for a longer time. How does this
Yes.
affect our own or your expectation of what the Banco Central should be doing, especially after Governor Diokno had already reiterated they will probably not be cutting rates further this year?
Well, in my opinion, it's a good decision for you to hold rates for the time being. I mean, our rates are already accommodative. The problem right now is people are too much reliant with respect to loose monetary policies in order to boost the economy. When in fact, monetary policy is just one variable of the equation. The main problem of the economy right now is really confidence. I mean, no matter how much
Mm-hmm.
money supply you inject into the economy, what matters more is the other side, which is money demand. And money demand is dependent not just on the level of interest rates, it's also dependent on the expectation of your future income. It is
Mm-hmm.
dependent on the expectation of inflation. And finally, overall, it's dependent on how the economy is going to be moving forward. So I think I believe that the monetary policy has already done its part. It's a good decision to
Mm-hmm.
hold rates for the time being. And what's more important right now for the economy is to bring back that confidence. Now, for that confidence problem, I think what we really need to do is to improve our means, our ways in addressing the COVID-19. How are we going to
Mm-hmm.
contain the virus? How can we further slow down its spread? Well, right now we're averaging a little above 3,000, better than before when we were
Mm-hmm.
hitting 5,000, 6,000. But we need to see more progress in that. We need to see a further slowdown. Once we already see this virus contained, then I think that's going to be the start of improvement in the confidence, especially in the part of investors, which in turn is going to help spur the economy back towards its growth trajectory.
Jafet, you mentioned that monetary policy has done its part, at least for the rest of the year. But still, the Banco Central is keen on helping the fiscal side. They're going to be buying back some bonds and releasing liquidity. And this liquidity from the central bank will be used to finance the pandemic efforts. Some analysts closely watching emerging markets doing this sort of thing are warning against the risks of the independence with the central bank because in theory they can keep issuing money just to finance the pandemic. Is this a risk that there will be some sort of contagion and increase the risks in our financial sector?
Yes, that is a risk that we have to consider. First, you need the independence of the central bank. In our case, the Banco Central. Remember that the number one mandate of the Banco Central is price stability. So we need to keep price in check. Price stability and at the same time monetary policy that is conducive with economic growth. So with the monetary policy pumping in more money into the economy, it poses risks to both of its objectives. Well, you see, if you're going to pump in more money into the economy, if monetary policy will keep itself loose, it can have two possible outcomes. One, you pump in too much money supply into the economy, and you'll be causing a great boost in aggregate demand, which in turn
Mm.
would lead to inflationary pressures. That's
Mm-hmm.
number one.
Mm-hmm.
Number two is you pump in money in order to keep interest rates at low levels. And by doing so, you would be promoting what you call the zombie firms, or firms that under normal market conditions or under normal bond market conditions would not be able to operate, since their operating income is not enough to cover interest expenses.
Interesting.
And if you keep zombie firms existing within the Philippine economy, then in the long run, it's going to be a drag on the overall growth of the economy. Right now, we are into a recession. Yes, generally, recession is bad. We're talking about output losses here, which is trickling down to the household level. At the same time,
Mm-hmm.
we're talking about job losses here. But if there's a bright side to recession, recession is can be considered as the cleansing process. It is the stage whereby the economy gets rid. It's a process wherein the different sectors, the different businesses of the economy is challenged in order to see which ones are resilient. Those which are
Mm-hmm.
resilient would survive and would be able to take part in the next expansionary phase, while those ones which are not resilient enough, they will be liquidated. They will free up resources which can be put into better use moving forward once we get into the next expansionary phase. But if you keep these non-resilient firms ongoing through lower rates, then it's going to be a drag to the economy moving forward.
Okay, let's talk about some bright spots here. Why the jump in remittances? Again, another surprise month here. A lot were saying that that was a one-off, the previous sprint. But still, that hasn't happened. Some are even saying that, with the more difficulties here in the country, even with the difficulties offshore, our OFWs are becoming even more generous and trying to help out. Is this good? Is this a surprise upside for you? And is this trend sustainable?
I beg your pardon, Miss Danny.
Yes, I was talking about the remittances, which you can see
Uh,
on my screen here. I'm not sure if you can see my
I see.
terminal here. There.
Mm.
Yes, I wanted to ask why this surprise jump in remittances yet again for the month of July. A lot were saying that the June print, which was very surprising, was a one-off event. Do you feel that there's going to be a sustainable trend moving forward that we're not seeing, that the remittances or the OFWs may actually be buoying our economy more than we had anticipated?
Oh, well, for OFW remittances, this is a good sign, and I believe this can be sustainable given the reopening of the economies around the world, especially those which are our top especially those which are our top destinations of our OFWs. So this one can be sustainable, and this is going to be helpful to the economy, especially with respect to household incomes, which is going to trickle down to consumption. The challenge, however, would be the risks, however, would be the persisting weakness in the global economy. Because as you can see, despite the reopenings, we still have signs of weaknesses abroad. And if
Mhm.
these weaknesses would persist, then it could drag down our OFW remittances moving forward. But these figures that we are seeing right now, brought by the reopening of the economy, of the global economy, it's a good sign, especially that
Mhm.
internally we are having a weak economy, so we will need as much external help as we can get.
Okay, so possible upside risk there would be the remittances. Let's
Yeah.
move on to specific stocks, Japhet. Going to telecoms. Dito Telecom has said that they will be cutting their spending budget for 2021. So they mentioned it's going to be 27 billion pesos compared to
Mm.
150 billion pesos this year. Is that something that's going to dramatically move the share price, especially since, there was so much excitement going on here, especially during the SONA, for instance, of President Duterte when he was targeting the incumbent telco players. But does it now appear that Dito might not be able to catch up to the incumbents as fast as people might be expecting?
Well, with respect to the capital expenditure of Dito, that is in line with their plans. They're planning to spend 257 billion in capital expenditure, 150 billion in the first year, and 27 billion in the next 4 years. So this is in line with their plan. The drastic change or the drastic decline in capital expenditure is understandable, given that it's their first year. It's natural that they spend a lot. I mean, this is the time wherein they're laying the groundwork for their operations. And moving forward, 27 billion, those will just be for more capacity expansion, for improving their services that they're going to provide to the consumers. What worries me here is that, as you've mentioned, 27 billion, this is low compared to the capital expenditure of our current duopoly, which
Mm-hmm.
is Globe and PLDT. If you're going to look at their 2019 capital expenditures, Globe was at around 51 billion, whereas PLDT's capital expenditures is at 73 billion pesos. So if you're going to compare that with Dito's 27
Mm-hmm.
billion, it's quite small. So two things can come out here. It's either Dito is efficient enough to provide the same level or even better services than Globe and PLDT at that low amount of capital expenditure, or it's the second possible thing is that Dito really doesn't have that financial capability yet to have a capex that can level up with Globe and PLDT. And if the second one would be the case, then this is going to be a negative for the third telco.
Okay, so something to be watching out for here. Expected amount, but still lower than the incumbents. And finally,
Yep.
just a quick check on AC and what their plans are right now. What's going on here? They pulled out of the Infigen stake, which was something that investors were very excited for in their energy unit. Their A rate is going further, going on, despite the suffering in the real estate sector, and they're now pivoting, or not necessarily pivoting, but refocused on expanding their health platform. Is this going to be a positive for the parent company in general?
For Ayala Corporation, yes, we've been seeing developments lately, especially that recent one where they're going to expand into the health sector. And given the current situation that we are in, the new normal that the economy is moving into right now, of course, there's a change in the industrial landscape. There's going to be new losers and new winners, and the health sector seemed to be one of the new winners moving forward, given the health awareness that has been raised because of the pandemic crisis that we are in. So with respect to the move towards the health sector, more investments toward the health sector, I believe that would be beneficial to Ayala Corporation. Property sector, their property segment is taking a hit right now. So with a REIT, it seems to be a good move since this is for the acquisition of the teleperformance building in
Mm-hmm.
Cebu. And moving forward for the property sector, the best thing that we could see right now is for them to move towards for their portfolios to be more lenient on office space leasing, because moving forward, this is the one which is seen to be gaining more progress as the economy enters a new normal. I mean, if you're going to look at both the foreign direct investments as well as the foreign direct investment pledges, there's been a progress in the inflows towards the administrative and support services, majority of which is going to the BPOs. So this is going to be helpful to the office space sector. So it's going to be helpful for the office space segment. And so Ayala Corporation's move through AREIT is also seen to be beneficial. And finally, as for its energy sector,
Mm-hmm.
AC Energy. Yes, they pulled out of Infigen, but if you're going to look at it, they're also doing more investments in other renewable
Mm-hmm.
energy sources. If you're going to look at AC Energy PH, they've been doing a lot of acquisitions lately. And moving forward, we believe that renewable energy is the future of the energy sector in the Philippines. So this is a good investment scene for for AC Energy and for its parent corporation, Ayala Corporation in general.
Okay, so thank you for those insights. Ayala Corporation trading flat at 715 pesos this Friday morning. Thank you so much, Japhet Tantiangco from Philstocks.
You're very much welcome, Danny.
And that's a first look into the business day this Friday, September 18, 2020. Catch us again Monday morning, 10 a.m. I'm Danie Laurel, and we are One News.